Okay, sounds good. I think Carter's also going to be running maybe 5 minutes late. We're finishing up some reviews in regards to employees at the company right now, so he's going to be finishing that up. But yeah, we'll kind of get things started in regards to what we're going to be talking about today. So today we're going to be discussing a few models of proposed models for bonds and shade bonds specifically. So there's a couple different models that we have. Moon Royalty and Carter are going to be discussing one type of model, and our community members Origo and Waffle are going to be discussing a different type of model. And we've been kind of going back and forth in our chats for the Shade Spartans in regards to what model is the best, kind of the economics behind them, and how they're going to be laid out. Moon Royalty, do you want to talk a little bit more about these?
Sure. Yeah, I think the first thing I think is helpful is just like, what is the purpose of the bond, and then also maybe like just discuss the way that shade tokenomics work a little bit, because I think there's also a little bit of like a misconception around like how new shade is created, because I noticed Waffle said that there will only ever be 10 million shade. So um, I guess it's useful to point out that 10 million shade is actually the starting supply of shade. And within that, I think it was 10 or 15% was given to the treasury. Um, and then, so like, what is the purpose of the treasury? I mean, the treasury is the DAO. That is where we will have money owned by the Shade protocol, the protocol owned liquidity, to further um, give benefit to Shade dApps. And so, I think the Waffle model, which if anyone didn't read the forum proposal, it's essentially asking people to buy Shade off of the swap or use Shade that's in their wallet and deposit it with another asset as a LP token to then get this Shade discount through the bonding mechanism. And then the Bird model is essentially, hey, we have this 10, 15% of the allocation that's sitting in the treasury the purpose of the protocol, and that we should basically use that to bootstrap the liquidity. And so, from my perspective, the Bird model is beneficial because one thing that would be economically inefficient with buying an LP token is paying a premium for your own asset. So like I said, we have 10, 15% of all of the shade that currently exists sitting in a portfolio waiting to be used for the purpose of Shade protocol. So why would we pay someone like, you give me 10 shade and I will give you 11 shade back? That is essentially what would happen if you were buying LP tokens. So from my perspective, like I said, like bonding is actually the only way that new shade will come into existence. So the more shade that we give out, the more inflation of shade occurs. And so like to get the same level of depth of liquidity, if you needed to buy 100 secret, maybe that's 10 shade. But now if you wanted 100 secret worth of liquidity in the Waffle model, you would actually need to give out 200 shade versus the 100. So to me, it's really about like the inflation of shade as an asset. And it's really about minimizing the premium that you're paying for assets which you already own. And so the basis of this mechanic is really borrowed from Ohm. And I have a hypothesis. I don't know, I wasn't there, but I feel like the Ohm model um, was kind of not about treasury management. Like the treasury wasn't really there for the purpose of like making decisions about allocating capital. It was really just there for the sake of being there. And I feel like our treasury is being built in a way that has so much more functionality, like, you know, the ability to LP it with a token already. So yeah, I mean, I could look up maybe like Ohm tokenomics just to see if they even provided their protocol with any Ohm to start, but that would be like a basis for the conversation, I guess.
I think the both tokenomics cannot be compared at all because the two protocols are not the same, but they invented the bonding mechanism. And through bonding, you have the minting of a new token. So I don't know if we could compare both, but I know that I'd rather in the waffle model actually it's not the waffle model, it's just the Olympus model. It's keeping the treasury and minting new tokens. So this is just to preserve the treasury.
But for what purpose is what I was. I think you joined maybe a little late, but I was describing like the treasury that is set aside for this purpose, like expressly to add protocol owned liquidity. So it's like when you say like preserve the treasury, it's like for what? Because this was the purpose of the treasury.
But Ranger, what you're missing is that the present value of Shade is probably quite far off, or anybody here probably sees it as being in the future. So the point is you're currently inflating your supply bit by bit by minting through inflation, and you're gaining Shade because the model has a much higher amount of Shade than the Bird model we've had, because there you're reducing the amount of Shade you hold, which means that once you get to a more realistic valuation of where Shade deserves to be at, you have a far greater amount of value that the treasury can then deploy to boost liquidity even further.
But the way that DEXs work is if you even if we use the price of Shade today and we put 100 Shade in an LP pool with Secret, if the price of Shade goes to 1,000, that doesn't mean that we somehow didn't get the equivalent amount of Secret. Like there would still be IL and we would get a ton more Secret into our protocol.
You would still lose the Shades, which would have taken value much more than Secret. The potential of growth from Shade is much bigger than for Secret because of tokenomics, because of many different reasons. So in the end, let people taking advantage of the bond buy the Shade, accept the loss, create the LP, and just provide it to the DAO. We keep the treasury for future endeavors, which can be different. And in the other hand, it creates like a true economic activity. People buy, so you have a small buy pressure. They LP it, so the liquidity gets bigger and grows. And then a few weeks later, rational investors will dump it, but the liquidity will already be bigger. And we can keep pushing like this until we own the market. And then we would be the ones buying and selling Shade. We would still have our treasury, and it would have brought some volume in it. It's some kind of dynamic that you boost. Maybe you're giving away, you're giving Shade for Shade, okay, but behind you've created a big dynamic.
It's functionally the same as long as you're not paying a premium for your own asset. Like the buying pressure that would occur from purchasing Shade is a one-time buying pressure. You buy the Shade to LP it, and then you give the bond back to the protocol, and then you dump the Shade. That's just wash trading. So like you're getting 30 basis points of transaction fees on that. So unless the bond discount is less than, let's say 15 basis points or something, or yeah, 15 basis points, I think, or 60. The direction is, but like basically the discount would have to be super low. Otherwise you're losing out, even with this fake buying pressure.
Discount would be low, but on the other hand, you're creating some positive movement in the market. So when people are buying Shade to bond it and give it to the protocol, they're making the price go higher. So the first person who will bond maybe 10 Shades, but the last person at the end of the bond policy will maybe bond with Secret, I don't know, 7. So this would have created also some kind of pump. Some will dump, others will create bond with whatever they received. That's what happened with Olympus. So people receiving discounted Ohm, they're pairing it with DAI and giving it back. So this is the kind of how we call it, financial volume that we're looking for, and that will bootstrap the liquidity. And the more people dump, the less the price impact it will have. Because meanwhile, all this happened, the liquidity grew.
One key difference between us and Ohm is Ohm was promising to pay out APY. So like
we're just talking about the bonding mechanism. Those protocols, they have absolutely nothing in common between the promise and the project, but the bonding protocol is actually the same.
Well, we're already changing what bonding means. Like, so the way that our bonding works is already different than Ohm's. Like, you know, the value of a shade is not $1 and we're paying out all the rest of it. I don't really agree with it. I mean, it's functionally the same if there's zero discount on the bond, right? Because then you're just giving 100 shade and you're getting 100 shade back. But once you start putting in a premium, paying for your own asset, then I just fundamentally disagree with that model.
Why this model has been working and has been applied for so many protocols in the last months.
So I'm gonna jump in here really quick because now the teams are even, just in terms of competition here. So for everyone who's joined, specifically, normally how we run these things is that we have very specific community members that have been discussing these in the chats, and these people are going to be speaking. We'll do a brief Q&A at the end of the Twitter space. So just if you guys do have questions, just know that they will have an opportunity to be answered. But for everyone else, contextually here, so we've got Carter and Moon Royalty kind of on what they're calling the bird model of bonds. And then we've got Secret, Waffle, and Anon here talking about the kind of OG version of bonds, kind of more the Ohm model, but what we've deemed the Waffle model. And obviously, as you can tell, there are some very key differences in regards to how is the treasury utilized. And then specifically what I think we were about to get into was sell pressure on shade specifically and what that looks like in the two different models. But since Carter just joined, let's give him the stage really quick just to kind of get him up to speed in regards to what's been mentioned and what hasn't yet.
Yeah, apologies for being slightly late. Was hopping off another meeting. But if someone wants to give like the 30-second TLDR of Waffle versus Bird discussion so far, that would be super helpful. And yeah, we can go from there.
Well, the Bird model, basically you use the treasury to buy a single asset token only. You might issue a discount or whatever, but essentially what it is, you're trading shade for a single token. The Waffle model, you trade shade for an LP token, which also comprises shade. So a criticism of it could be that you are issuing discounted shade for the nominal value of shade. But the key difference is that the Waffle model believes that the treasury should not be used at the early point of the protocol. Rather, you should use inflation to mint additional shade.
Interesting. So my question for that would be, like, at the point that you're minting shade to give out to a bond, how is that different than grabbing from the treasury first and then refilling treasury with shade later? Like, it seems like an interesting demarcation, and I'd love to like understand the conceptual difference between minting now versus minting later.
Well, the train of thought kind of goes along the lines that the value of shade is relatively low right now, relative to what we believe to be its future value and what it deserves to be, of course. And the view is, if you're inflating now, the value of the inflation will be nominally smaller in terms of how much output you can get. So 2% inflation of shade at the current moment will yield a lot more than what we would be able to do in the future, because 2% inflation in the future would be quite a large amount, so to speak. And the thought is that, at least when I modeled it, the amount of shade that is emitted through inflation, 50% less half of the discount will be returned to the treasury. So that is the net increase you will see in the treasury, with 50% plus the discount rate being emitted to the people, of which a portion will also be returned through transactions if anyone sells their shade. So realistically, it's quite an even distribution of shade, and one that benefits the treasury a lot in the longer term, while not really having a cost to the user that's going to buy any bonds.
Interesting. So it's almost like it's preserving its own purchasing power, is kind of, in a way.
Yeah, because really you're growing your treasury over time as opposed to just redistributing one asset into another. Because you're theoretically, the bird model, your treasury stays the same in value at the time of execution. It's just there's going to be two different assets as opposed to one.
And this might be where I guess I disagree with the waffle model, because I view the value of the treasury as everything excluding our own assets. Because basically, if you have a treasury of just shade, you have no value. Once you have a treasury of Bitcoin, Secret, Ethereum, whatever, then it's like you have value that you can tap into. That's like true, if that makes any sense. Like, and that's why I guess like when it comes to like deploying the treasury for assets, to me that's like a simple decision, because then we have basically other ways to unlock value. Because I don't think there will ever be a point where we'll want to just market sell shade, right? So it probably only makes sense to use it to LP.
No, actually, we will, for example, if you bootstrap some liquidity on a future swap, we will have this shade that we can use. If we're paying for a future grant or incentivizing on a future pool, we take the shades from the treasury. But if we do it now, when you start giving away cheap shade instead of minting cheap shade, then in the future when shade will be valuable, well, we won't have that much left when it comes to incentivization. Yeah, incentives. So yeah, that's my whole point. Supply is low, price is low, liquidity is low. Let's mint a little bit of shade that will inflate a little bit, but create some real dynamics around the DeFi of the protocol. And in the future, when shade will take its real value, well, we'll be still sitting on a stockpile of shade that we did not waste when it was cheap. That's my point.
I think to dissect that, I would say that there is a pool of assets of shade available for grants outside of the treasury. So it's like partially it's like defining like what are the treasury assets. And then I would say too, like when you look at the US dollar value of shade, maybe it's not as valuable right now, but when you look at it from like a ratio perspective, like one shade is still 10 secret. So like one shade or 100, what is it? No, 100, no, 100 shade is an Ethereum. So it's like, I don't know. Are we going to use 10 or 15% in these initial bonds? Like, I guess that to me would be like a big part of the question. I don't see a reason to defend the entire allocation that was set aside for this purpose for, the future.
I'll hop in here quick and say that interestingly enough, like there is an allocation for LP rewards. And so I think that's like maybe, yeah, a lot of this comes down to like how you view the treasury, because personally I view, what is it? I think it's like 16% is pulled aside for LP rewards right now. It's like, I think there's a general consensus that it's better to use shade to permanently acquire assets than to pay for a temporary like service. And I think that forum post, or I talk about it at length, kind of describes that scenario and kind of the absurdity of LP emissions. So in my mind, it's like we pivot the LP amounts to be more focused on bond issuance. That's the pool that we start from. And then once that runs out, you can continue to mint shade for bonds. But the treasury's allocation, which I think is 10%, which is separate from grants, that can be used however the protocol wants. And that's where that shade can be used to either be like liquidity providing, could be used to increase staking rewards. It can be used like anywhere. So I guess, Waffle, I'd be curious, like for the rewards that have been earmarked for LP, does it make sense to use that for bonds, or would you still say that it, like in your mind, why not just like mint the shade? I'm just trying to understand like how you're demarcating the different allocations in your mind.
I would say I'm pretty conservative. So if a previous model of bonds through minting new tokens has worked and is working perfectly, I wouldn't go into weird endeavors and giving away treasury. I would cherish the treasury, especially when it's undervalued. I mean, that's my initial approach. I don't say that buying only secrets and pairing ourselves the shade from treasury with secret and owning this liquidity would be bad. I'm not saying that, but I tend to even if the risk is giving away shade for cheap for our own asset, I'm really looking forward to that dynamic that it would create of people going on. If you choose Sienna Swap for the launch, going on Sienna, we teach them, we explain them, or we can even put a link on the website, I'm sure, calling the contract for the pooling, and then bring that to the Shade protocol and give it away, waiting for, that's what I'm waiting and I'm looking forward to. But if we go with the easy way, well, that's also doable.
Yeah, the cool part on the front end is that bonds, like with the launch of Shade Swap, bonds will be directly integrated into the DEX itself, the user experience and workflow. So imagine minting an LP token and it's like, hey, you can deposit that asset into this bond that's available right now. Or you just purchase an asset and it's like, hey, there's a bond opportunity for that. Olympus DAO can't really do that. They generally like push people to go to Uniswap, make the LP token, and then come back to their UI UX. Whereas with us, we have the advantage that like we get to have all of that in one place and like a cohesive brand and user experience and workflow. That's going to be a cool advantage that we have.
I think one thing you have to consider is that for the Shade DAO to reach critical mass in terms of protocol-owned liquidity, it would take quite a bit of a longer time, and it likely means you have to basically rent liquidity off of people for longer, which means that I can't imagine it would be better to use the treasury more towards bonds rather than incentivizing emissions, because you likely need those emissions much longer than before we get to a point where we're basically to say we're free to run wild on our own.
I would just say that, like, when I think of the Shade tokenomics, it's like we're built on top of secret, right? So like, what is the benefit of that outside of privacy? It's like we don't need to have unnecessary inflation. That to me is like the number one thing. So like the bonding mechanism is essentially like, give us value and we'll give you an equal amount of value plus some premium. And so like, for me, that is the key of Shade. And so when you talk about like emissions, that is the opposite of that. Like that is just like, here's money. Like realistically, like the DEX liquidity depth on secret is so minimal that like within 2 or 3 bonds, we could beat any swap that's on the network. And that's not even like a goal. That's like a low level, of success. But I would say that bonding is the most critical function that we have. And so like the determination of this model is like super important. And if you think about like a traditional business, right? If a traditional business was offered the fact that they could save 3% of their cost, they would like kill someone for that. And we're basically saying like, we're going to give out an extra 3% in the Waffle model by paying for our own assets that we already own. And it just seems to me like that doesn't make sense.
I think one thing you're failing to consider is that if we're talking about inflation in terms of Shade, we don't really talk about inflation at the total supply level. Like the total supply of Shade isn't going to bother people if it's inflating. The thing that will actually affect you is the inflation at the circulating supply level, because that's where people will see an increase in supply, greater selling pressure, price going down, stuff like that. which, regardless of what model you use, whether you use the waffle model or the bird model, both are going to create an increase in your circulating supply. The difference obviously being the discount rate divide, where the additional premium required to be paid towards the shade, the discounted shade that's being repurchased. But obviously that's something that can be measured and be kept relatively minimal. We were discussing today about Secret and how we think Secret is quite a low risk asset in terms of purchasing bonds, and how we think that the discount level doesn't actually have to be very, very high for it. And really, that directly translates into expecting you wouldn't be emitting that much extra shade.
Yeah, it's interesting too because we're in a low liquidity situation as well. I know this is something that Austin has brought up before, but like there's actually an argument to be made that some of these bonds shouldn't even be offered at a discount, that they'd be offered at a slight premium, because your ability to acquire shade is actually better to do it at a spot price through a bond than trying to go and get the corresponding amount off of a DEX. That's super like not user friendly though, because then it doesn't make sense. It's like, wait, I'm not earning a discount anymore. But it's like, but actually, this is the best place to actually acquire shade right now with respect to existing liquidity. That's a whole different like conceptual conversation we could have as well. But I digress.
I was about to say that's an intensely deep conversation in regards to potentially not offering bonds at a discount, but offering them at spot prices, because compared to slippage on a DEX, like it would be the best way to get your hands on shade without experiencing hundreds of percents of slippage if you wanted to make a purchase over like 1,000 shade at once. Obviously that's a high number, but that's quite a conversation. I think another question that Anand brought up is a very good point in terms of entry assets. Specifically, Secret Network just announced a partnership with Axelar, and this conversation was also being had in the group earlier in the Shade Spartans chat. But I'm curious as to the viewpoints of everyone here, speaking on what entry assets we should be targeting, and what that would potentially look like. Maybe Carter, if you wanna kick us off.
Ooh. I mean, I think it's like, is Axelar going to be the gold standard for ETH stables and for ETH itself and for like wrapped Bitcoin? If the answer is yes, that like we see that the larger Cosmos decides to like really push in the Axelar direction. I know Osmosis is really big fans of Axelar. Then I think it's, for the sake of users and for liquidity, it makes sense to onboard similar assets. It's kind of a chicken and egg game though, because like you don't necessarily want to be the first to adopt the asset. You're kind of like want the network effect to kick in before you adopt the asset from said bridge. There's also bridge security risk, which I still think like there's some due diligence on our end that we need to do in terms of like checking out Axelar's model. From the looks of it, it's extremely safe. It's just essentially a bridge hidden behind a multi-sig the size of a validator set, and with like a bunch of other risk parameters, of course, too, but just to like keep it kind of drastically simplified. So I guess I won't give a very direct answer on it, to be honest, Dalton. I think it's like kind of have to wait and see a little bit how different IBC chains adopt it and which assets are prioritized. I'm really excited about ETH stables though, like Frax and DAI.
Yeah, absolutely. I think that makes complete sense in terms of making sure things are steady and stable before we actually jump into that, in regards to like bridge safety and what assets are going to be included and if they're safe or not. But I know Moon Royalty specifically had an opinion about this in regards to like what he would potentially like to see as accepted assets or things like that. So I'd love to hear his opinion.
Well, like right now, we were talking about the lack of DEX liquidity for the trades that you could make in Shade. So it's like, from my perspective, what we determine to bond for and through whichever model, like should be to create the deepest liquidity pool. And so like, what would that do? That would basically be the asset that we're tethering ourselves to. You know, the reason why crypto prices go up is like ETH is tied to Bitcoin, and then Ethereum is tied to Uniswap or Binance or something, and then that's tied to another asset. So like the market moves moves together for that reason. So whatever asset that we choose to bond to, we're basically hitching the price of Shade to it. I mean, like right now, the price of Shade is based off the ratio of Secret. Secret is $1, the ratio is 10, so a Shade is worth $10. And that's basically the question that we should determine, like, you know, which asset do we want to be most correlated with? You know, I would personally choose something like Bitcoin or something that has like super high liquidity and is part of like the what starts the bull runs. Like that would be for me, as opposed to like Secret, which, you know, there's something to be said for Secret because it is native. Everyone has some. You know, you could also look at something like Atom as, you know, a native asset that everyone has some, hopefully. Yeah, but that would be my that's kind of my thought on it. So
Yeah, for sure. It's a very interesting concept of what asset are you actually tied to as a project. Like you said, ETH is tied to Bitcoin, and subsequently, all of these other coins are tied to ETH. So it becomes a very interesting conversation when you're trying to decide what you want to tether yourself to. But Secret Waffle, I'd love to hear your opinion, and then Anon as well.
I'll tend to agree here with Ranger, and especially for the choice of Bitcoin as being the main pair, because yeah, like as he said, it's a matter of ratio, and we have an example in our ecosystem. We have Butt from Button Group, who's paired to Bitcoin, and when all of the assets have been divided by 10 because they were paired with an alt, Butt just divided by 3 during this dump, just like Bitcoin. So if you paired with the soundest of the money, you will just behave like it, and as sound money. So yeah, I'm definitely up for a main liquidity pair and being paired with Bitcoin for sure.
Without going on too big of a tangent, I basically agree with a mix of what everyone said. I think if we look at the bridging solutions out there right now, Axelar has basically begun to dominate the Cosmos space with Osmosis and a couple other chains. Gravity Bridge is, on a similar vein, quite dominant in a couple Cosmos chains. It only connects to Ethereum at the moment, though. And like Carter did mention about security, they're both effectively very, very big multi-sigs. I think a strong opinion, but I think, in my opinion, Nomic, which is partnered with Evmos, might be the most secure bridge, only because it operates on an optimistic model. So as long as one entity declares a fraud proof, the fraudulent transaction wouldn't go through. I think we should begin with Secret purely because it would begin the process of how we go forward from here, and it's the most abundantly available resource. However, then I agree with what the others have said about there is a very small liquidity of external assets still within our network. So bonds issued in regard to those will quickly make us the biggest provider of that pool effectively. I think the issue we have with Bitcoin more so than Ethereum is that we have quite a few different Bitcoin bridges that are likely going to offer us a way to onboard Bitcoin. And the issue with that then becomes, what do you choose? And then the friction where people have to go one route compared to the other. And so I think it might take a bit more time, but I'd like to see a decision eventually made on how we take Bitcoin forward for Shadeswap.
Yeah, I think that is probably honestly the most rational approach, I think, in regards to starting the process of, hey, what's most native around us and what's most abundant. Let's start the process with that, and then let's work our way outward when we have the opportunity to move on those. And then, like you said, putting in place a structure that allows us to make sure we're making the right decisions in regards to what we bring on on that path forward. But I think since this topic is relatively heavy and it is relatively complex, I would love to open it up to Q&A here. But just right before that, if anybody has any final thoughts, comments, or concerns, please voice them now, more specifically to the speakers, and then we can move into the Q&A section. Carter, okay, Carter jumped off.
I think
Waffle, yeah, do you guys have any last comments?
no explicit thoughts, but if anyone does have any great ideas, we'd still love to see it on the forum so we can discuss it in greater detail.
Yeah, absolutely. Well, yeah, let's open it up to some Q&A here. And Carter's back. Perfect. Carter, do you have any final thoughts? I know you accidentally jumped off there.
Yeah, I would just say I want to challenge us to think about what it would mean to like run both models like on a very small scale out of the gates and observe the impact of the two and kind of see like the community's reaction to both. Just because like I think the best option is always to run small experiments and see how the market reacts to them and like how everything kind of reacts. And I think like the difficulty of a small experiment is I guess the data set's pretty small that we'd be extrapolating out from, but that's kind of my vote. It seems like there's advantages to both models. Some of it has to do with the philosophical difference with like how you think about inflation, how you define treasury assets, what time frame potentially you're thinking about, how these operate within illiquid markets. But I don't know, that's how I'd want to challenge us as a group, is what would like a really small experiment with both models look like, and then go from there.
Sounds interesting.
From the marketing side, A/B testing is an absolute godsend, right? So it's kind of what you're suggesting. Yep,
in essence. And also to echo Anand's point, to your Waffle Ranger, everyone like be sure to hop on the forums and give feedback. Decision hasn't been made yet. Like I said, I'm biased towards experiments, but like it's gonna be, the jury's still out. But I think this is a super, super helpful conversation. And hopefully everyone that was on here today, Waffle, Anand, Ranger, myself, can all go to the forums with our thoughts from what we learned today.
Yeah, Waffle, I saw that you unmuted for a second. Do you have anything to add?
No, I kind of like the idea of Carter giving it a try. Maybe 10K bond opening with the Waffle version, 10K with the Ranger, and see what happens.
Perfect. I do see Amir requested here, so Amir, we're going to bring you up. Welcome. Thank you for joining the Twitter space, and feel free to ask a question. You should be up. Looks like you're on mute currently.
Yes. Hi, everyone. Thank you very much for expressing your opinions on both models. I'd like to ask about actually specify about the targeted assets. Maybe not to overlook Monero as an important asset to have on targeted, and also Anand, you briefly specified the question that basically that I'm keep as this conversation is going, I keep having in my head is the time frame basically of this bond issuance and how long it will take basically for the discount. How long after that we issue both models? How long do the discount go for?
The bond is issued, you can define it. I think there's like a minimum of like X number of blocks all the way up to, I don't think there's really a limit on like how long the bonds can be issued for. So they can be deployed, they can be taken down in terms of opportunities. So you could have a vesting period, like you predefine the vesting period, however long that goes for, and then the bond stays open essentially as long as the protocol wants it to stay open. So eventually governance will fully be able to manage these different components. But there's they've been designed with max flexibility. Like Like if you wanted a vesting period of 3 years.
Hello, is it good enough?
Oh, yeah, Carter, you cut out there a little bit.
I think we may have lost him. But yeah,
You're
to finish
I 3 years.
to finish that off, I think Carter meant to say you could probably have it as long as you wanted. And on a slight tangent to the other question you had, I do think I think most people here would probably like to see quite a deep Monero pool held on ShadeSwap and the DAO. I just think that there's a small struggle currently with the bridge that we have at the moment. I think if there was probably a solution that was a bit more easier from a UX perspective, it might be quite good in terms of seeing a lot of Monero flowing in as well.
Thank you very much for your answer.
Yeah, thank you, Amir, for having a couple questions for us. We're gonna bring up Red Eye here. It looks like he has a question. So let's bring him up. Red Eye, you should be up. Welcome.
How's it going, guys? Can you hear me?
Yep, loud and clear.
Awesome. Super glad that you guys did this Twitter Spaces. It works out with perfect timing because we're planning on doing a recording of a Bonds episode later this evening. Shade 14 Carter will be joining us for that. But one of the main things I've been thinking of while listening to you guys talk about the proposed bond issuance models is we're thinking about this right now from the standpoint of like, what is this going to look like in the beginning? And that is a super important portion of time to focus on. But as we get to mainnet, as the total supply of Shade becomes more decentralized, all of this decision making is going to go back towards the community. And Carter kind of hit that point just a few moments ago. And one of the things I can't help but think about is, how do we enforce the same sort of like due diligence from the community when it really is up to us to make these decisions rather than relying on a core team of people to help us make these decisions. And I'm not saying that the core team isn't going to be there, or any of the people that are in this Twitter Spaces right now aren't going to be there later on to help out with these discussions. But I'm personally curious as to like what these conversations are going to look like once control is more fully in the hands of the community. Like, we're talking about what assets we want to focus on acquiring first. What assets would we really ideally like to see Shade kind of connected with as far as price correlations are, and then taking these steps 6 months, a year down the road, and revisiting this and saying, okay, do we want to start acquiring different assets? If we're not seeing the same sort of performance or market evidence that our decisions were maybe the best that could have been made, how do we go about changing that? How do we keep each other accountable? And then ultimately, what does that decision-making process look like? Because I know Carter had mentioned that, especially with how Shade Protocol and the interconnected apps are kind of being set up right now, you're going to be able to interface with all of these different primitives all within the same landing page, which is really, really awesome. And so I know I just kind of spouted off a couple different ideas, but mainly I'm really thinking about, how are we going to focus on properly incentivizing and keeping the community accountable when making these decisions in the future when we're at a more decentralized point.
I think that there's going to be governance, which will essentially be a sanity check upon a team of people empowered to create bonds. So let's say the team, with feedback, is like, we're going to create a Bitcoin bond, and then governance would vote on the idea of like, is this a rational decision or not? And then I think the assets which could be bonded for, I would have to get confirmation from someone that's closer to this process, but I think that there's basically a whitelisted set of assets, and you would have to vote to get it on that list, and then you'd have to vote to make a bond, and all of these would have some sort of governance response to them.
Yep, Ranger's exactly right. So designing. I mean, we could have a whole call to talk about like assemblies and governance, and we could pull Guy, the lead dev on governance, onto like this type of Twitter space to talk about the current structure. But in essence, like you need to be able to empower a subset of actors to perform certain functions for the protocol for every key primitive, like decisions about the DEX, decisions about bonds, decisions about Silk's peg. And so this DAO is going to rapidly grow into many, many different functions. And essentially baseline token holders will be able to vote to elect people onto what we're calling assemblies. And these assemblies essentially have scoped access to take certain executions, take certain actions for the protocol. And then you have regular elections for those multi-sigs, re-elections. And then there's something called sanity checks, where like every single baseline operation has to get approved by baseline governance, but it has an extremely like has a much lower quorum, because you have to strike a balance between performing operations for the DAO while still having baseline accountability to underlying token holders. And governance is something like, as a protocol.
Did we lose him again? Carter, we lost you for the last like 10, 15 seconds here.
Okay, I was just saying that we used to talk more.
He came back to go.
I think what Carter was talking about really answers my question. I just wasn't sure how governance was going to be completely set up to handle, implementing some of these changes. I'm sure the Shade Protocol white paper, the sections that include governance, still have some updates to be made. But I know that there is a primitives branch, and I was basically just wondering, is there going to be these different assemblies within this primitive branch of governance that has more like direct or intimate control over the direction of these primitives? Obviously, with the approval from a wider scope of governance. Like
I'll say this. Can people hear me?
Yep.
I'll say this. The beautiful part is that assemblies as a concept, any number of assemblies can be built with any degree of functionality. So like the community can collectively say, hey, we believe we want to empower this subset of actors to be allowed to take this subset of actions. So sky's pretty much the limit for how we like cut and slice and form governance. Like that flexibility is there, and that's really good news for us. We essentially don't know what the final form will actually look like, but we have the tools to be able to build it. And so we're going to need people to take lead on how many assemblies are going to exist, what precise actions can they take, what's the metrics by which we're measuring all these different groups. It's gonna get real, a solid amount of entropy, but I think we prefer the entropy to some other DAOs where it's just like, hey, this is the policy, we executed on it, hope you like it, like take it or leave it. I think Shade Protocol, because we have such a long-term vision, we value decentralization while also understanding that we need to empower a subset of actors to take daily operations in the name of the DAO. So it's gonna be interesting to navigate, and we definitely need to circle back more on the value and effectiveness of governance. Like as we launch the products, I think we should start to have more focused discussions as a community again. So thanks for bringing that up. Definitely agree.
Yeah, and I'll just say what you're saying makes me feel really positive and bullish. Not that I wasn't already, but about the outlook for the future, because I feel like a lot of primitives, they get kind of stuck with this original choice that they make, depending on how much flexibility there is in changing various parameters associated with primitives. And so knowing that we as token holders and we as the protocol, like the general protocol, can make these really like really detailed changes is really good for the long term health, I imagine, because we're going to want to be reflexive with what's going on in the market, what's going on with other protocols as they're developing new potential methods. Like I know there was another potential bond issuance mechanism that was put in the Spartan chat. I think it was yesterday. What's it called? The chicken model. So being able to like look at new models that are being discovered and come up with, and being able to look at, hey, can we potentially implement this in the future?
Perfect. Ranger, I know you're unmuted here, but Red, thank you for the question. Ranger, if you have anything to add, feel free. But if not, we're going to bring up Zenepi here. He's probably our last question for the day, just because we're running low on time here. So, okay, I saw Ranger muted, so we'll bring Zenepi up. Zenepi, you are on stage. Welcome.
Hello?
Got you loud and clear.
Hey, so have you thought about maybe offering staked shade or a staking derivative of shade for longer vesting periods?
Yeah, I
Interesting.
think,
So you're saying offer a bond specifically on people giving back a derivative to the DAO?
For like a staked shade, a shade staking derivative. Instead of
Yeah, we're working on the staking derivative actually, like as we speak. It should be, we're kind of in a situation where the derivative will actually probably be launching side by side with staking for Shade Protocol. So staking derivative is definitely on the table. How it interacts with bonds, I haven't put too much thought into it. I've definitely put more thought into the secret staking derivative product and how it interacts with the protocol because it's yield bearing for the treasury. But we definitely could spin up a thread for staking derivatives. Also, staking derivatives are kind of designed differently than normal staking derivatives, so that it warrants its whole own discussion. But it's a great question. I'd love to hear more about what your ideas are surrounding how we could leverage staking derivatives and bonds with Shade.
Thank you.
Yeah, Zenepi, I think that's another perfect protocol discussion that can happen on the forum, if that makes sense. And maybe you put up a thread, and then all of us kind of, as a community, collectively give our thoughts and opinions. But yeah, like Carter said, we're currently in development on that shade staking derivative, and then there has been quite a lot of thought put into what it would potentially mean for that staked secret derivative that Shade released earlier this year to be involved with the bonding process. But I think that wraps us up here today. We cut it off a few minutes early. I know specifically where I'm at, it's lunchtime, so I haven't eaten yet today. But yeah, I just want to thank everyone for jumping on and continuing these community discussions. They're really important to have, and like Red brought up specifically, like the more we can have these conversations, I think the better off we'll be. But special thanks to Carter, Ranger, Secret Waffle, and Anon for jumping on here and having these hard discussions. Thank you to everyone who asked us questions. It helps us gain new perspectives and make sure that we're not just siloed in one area. And again, it opens new opportunities to learn and grow. So thank you all for jumping on. We will be on next week, same time, same day. So make sure to mark it down in your calendars. They are listed in our Discord and on the Cosmos calendar and Secret Network calendar as well. But yeah, appreciate everyone jumping on.
Thank you. Round of applause.
Thank you.
Thank you, guys.
Have a nice day, guys.